Okay, welcome back, everybody. If you're new, my name is Nicholas, and this is Investing Against the Grain. In today's episode, I want to touch on inflation and the upcoming CPI report, what the Fed might or might not do moving forward with regards to interest rate, and more importantly, where are we in this whole battle against inflation? Where do we stand? So, without further ado, let's get into it. All right. So, the first thing I'm going to do is I'm going to go ahead and share my screen with you guys. And here we can see where we have been on a month to month basis with inflation. So, here what we're looking at is right here, the 1 month percent change in CPI. Let me actually blow this up a little more so you guys can see better. Okay, here we go. All right, so here you can see the 1 month percent change in CPI for all urban consumers. Okay, what you really need to understand is that CPI number that we get, the consumer price index, this is a measurement of a whole bunch of different things, right? From shelter to energy to food to services, all these things. They all have different weightings, right? And we'll talk about that in a second. But what you need to understand is that after all that is sampled and surveys are done to figure out what the prices of things are of these goods, then we get a certain change from month to month on what the inflationary effects are. And the Fed, the Federal Reserve, Jerome Powell and team, their goal is to maintain around a 2% inflation rate. Okay, that's seen as healthy. Now, in the last report, we got 4%, right? So, how did that 4% come about? Well, that's where this chart comes in, okay? So, for that 4%, if you add up the last year, right? So, if you go back 12 months, May, April, March, and these numbers here, 0.1, 0.4, if you add all of these up all the way to June, not to May, because May would be kind of May twice, right? That'd be 13. That would equate to 4%, right? Pretty straightforward. You just have to add it all up and you get 4%. So, what I've been kind of banging my fist on the table about lately, and I think it's like the only way you don't see this is if you don't want to see this. Okay, I think I talked about it yesterday during Fourth of July. People were telling me, "Oh no, inflation's still here. We're still increasing in inflation." Like you guys don't know what you're talking about, and that's where sometimes I forget that people don't follow this as closely. But so I just wanted to bring more awareness to this to everybody. So what's going to happen here on Wednesday is so these 12 we have here will no longer be the case. Okay. So you can see all 12 here, right? So from June to May, this will no longer be the case. The reason is because we will be removing this June number here, this 1.2%, right? So again, remember, when we add all these up, we're at 4%. The Fed's trying to get to 2%. We're going to be removing this June 1.2% with a new June number. Now, we don't know what that's going to be yet. That's the whole point of the release. But if this is any indication, then it looks like we're going to be in the low 3%. Why is that? Well, because you can see that this last CPI report, we're at 0.1. Now, mind you, the previous one we're at 0.4, before that 0.1, 0.4. But the point is, you can see that we're trending downward, right? We're not going to see another 1.2. So what are the expectations? Well, the expectations are for a 3.1 CPI number, right? So if this all adds up to 4 and you subtract the 1.2, right? That would mean you're at 2.8. If they're expecting a 3.1, that means they expect about a 0.3, 0.2 numbers what they're looking at, right? So the point is, if you look at all these, then this tells you we're going to be in the low 3%, one way or another. Now, my guess is that we will potentially, there's some potential for some really, really good news. Now, we see 0.1 here for May. If we see another 0.1 for June, right, to replace this 1.2, well, that means that we could be in a, what, 2.9%? Is that math right? Right? Because if this all is 4 and we get rid of 1.2, that would put us at 2.8. You add in a 0.1, that's 2.9. That'd be a 2.9%. That would be a 2 handle on inflation. Now, there's no guarantees we see a 0.1. There's no guarantees that we also see anything higher. We'll find out what it is. But either way, the main point is that we are seeing CPI come down. So we're going to be lapping this big, big number. And there's a potential for really good news where we could be in the 2%. There's potential for really good news where we're in the very low threes. And yeah, there's potential for, bad news where maybe we see a zero point 0.4 number and we're at, like a 3.2, 3.3. Either way, we'd still be in the low 3%. So I think really no way you slice it or any way you slice it, this should be a good number one way or another. Now, there is something to be aware of, right? Right now, the biggest thing so let's take a step back. CPI, the biggest component of CPI is shelter, all right? And shelter is extremely tricky. The reason it's extremely tricky is because it's hard to calculate. Now, first of all, before we talk about how to calculate it, let's talk about how big of a part of the CPI it is. It's about 33 to 40% of the entire CPI, right? That's the weight of it. So this is the biggest part of the CPI reading that we do on a month-to-month basis. Now, what's unique about CPI, about the shelter index within CPI, is the way we get the numbers for it. So there's two different metrics for the shelter. You got rents, which is pretty straightforward, and then you have owner's equivalent rent. So let's talk about rent first of all. Rent is about, call it 22, 25% of the shelter number, right? So if rent is 22, 25% of the shelter number, that's pretty straightforward. That's your apartments, that's renting random houses, right? That's pretty straightforward. Now, how do they get those rent numbers? Well, they actually do it in a 6-month interval, right? And why do they do that? Because everything else, right? Food, airline tickets, random goods, services, they do that on a month-to-month basis. Why would they do rents at a 6-month interval? Well, the reason they do that is because there are a lot of people who are in a current lease, and those leases won't be up for a long time. And then there are some people who are looking for new leases in that given month. So they try to find a medium balance there. And the way they do it is if they will, like I said, look in 6-month increments. So there will be a survey that's done for January and for July. And then there'll be another one for February and August, and another one for March and September, right? And it goes on and on. So it's those kind of 6-month gaps that you'll have. And the reason this is really convoluted is because let's say if we're in our current situation, in January, we had really high rents, but now here in July, we have low rents. Well, when you balance those out, you really don't see the reaction of the today inflation. You see the reaction, you still see a weight effect of the higher rents that we had back in January. So that skews things. And we see these numbers come in 6 months intervals. And so what that means is that CPI, when it comes to shelter, actually tends to lag about 6 months. I'll give you an example of this in a second. But again, remember, I said shelter is about 33 to 40% of the whole CPI. And within shelter, you have two main components. You have rents, which we talked about, and that's about 20 to 25%. But then you have another section called owner's equivalent rent, and that's about 75% of the entire shelter part of CPI, right? So there's a lot of numbers to juggle in your head there. So 75% of shelter is this owner's equivalent rent, and shelter overall for CPI is about 40%. So what is owner's equivalent rent? What does that mean? Well, with homeowners, when people buy a house, we don't actually see that as something to be measured for inflation. Why? Because because the government sees that as an asset. They see your house as an asset. So they don't actually measure the selling price of a house, right? They see that as an asset. So that's put to the side. So instead, they try to guesstimate, and yes, they guesstimate is what they're doing. They try to guesstimate what a house would rent for, right? So it's very convoluted on how they do it, but that's a huge part of this. And really, they're asking a lot of homeowners what they think they could get for rent, which again may not be the best metric. But either way, this lags. Okay, you still have that 6-month lag. So let's take a look at first of all, let's take a look at where we currently stand with CPI when it comes to the rents. Okay, so let's take a look here. This was, if I scroll up here, actually, let me make it big again. I'll make sure you guys can see this as clear as possible. And I'm going to zoom in and make sure we can see this. Okay, so here you can see again, this was from June, right? This is the last one we had, June 13th. So just so you know where we're at. And if I zoom out here, we can read The index for shelter, remember 40% of CPI, was the largest contributor to the monthly all items increase, followed by an increase in the index for used cars and trucks. All right. The index for all items less food and energy rose 0.4% in May, as it did in April and March. Indexes which increase in May include shelter, used cars, trucks, motors, et cetera, et cetera. Again, the reason we're seeing May in this, and this came out in June, because remember, we're looking at backwards looking data. So when this came out in June, it was it was looking back to see what inflation was in May. So now when we get the CPI report on Wednesday, we're looking at June's inflation, not even today, not July's inflation, right? So it's backwards looking data, and this is what a lot of people don't like about the Fed is that they're looking when we get the CPI report, we're not actually getting today's inflation. We're getting a month ago inflation, right? So it's very convoluted. But with that said, keep in mind, this said that the shelter was the biggest part. So let's take a look at that. What was that shelter? So here again, you can see all the main items. We got food, we've got energy here, we got energy services, utilities, all that good stuff, right? You got new vehicles, apparel, services, less energy, right? But what we want to focus on is shelter. So let's take a look at shelter right here. Okay. So if we come all the way over here, you can see it on the month to month basis, right? And remember, these are coming in those 6 month intervals, right? So these aren't actually reflective, but this shows us that we are at 8% in aggregate, right? On the trailing 1 year, we're at 8% inflation. Now, this was for inflation that we saw, we got the results here in June, right? For May, right? So we are in July right now, but this was 8% for that, okay? Now, again, this is the biggest part. So let's take a look at where we are currently with inflation from true inflation. What's true inflation? Well, true inflation is a attempt to get accurate 2-day inflation by taking, and you can read their whole methodology. They have a whole thing here about their methodology, but essentially they're taking a look at everything on a day-to-day basis and trying to give a good representation in real time, right? They're essentially trying to do what the government should be doing as far as providing real numbers. Now, in general, true inflation is about 2 months ahead of where the CPI is. All right. And this has proven accurate over and over. In fact, if I just zoom in here for you guys, let's see. We are, let's say, call it right about, right about here. So this was April. In April, we were about in the 4%, right? We got to 4% right here, April, right? We got the numbers, the 4% reading, we got that in June, right? So there's your 2 months, right? April to May, May to June, 2 months. So this has been pretty accurate on that. Now, what's interesting is if we go into the housing part of Trueflation. So let's take a look at this. Trueflation right here. If you look at, we have 3 different categories here. We have housing total, owned dwelling, and rented dwelling. We're going to focus on the housing total because this is more of an aggregate of both. All right. So if we look at the housing totals, let's find out when we were at the 8% mark. So I would say call it right about, all right, somewhere right here. Let's say 7.7 now. Let's just call that 8, right? So this was on January 8th. Hopefully you guys can see that well. This was January 8th. Again, January 8th, we're about 8%. And do you recall what this last CPI was? It was 8%. So this 8% we're seeing here in those 6 months time frame, right? Is that a coincidence? I don't think so, right? We're 6 months away essentially from January. And here we're going to start seeing this inflation drop. So this is something that people are very bullish about. So here we can see that right now, Trueflation is saying that it should actually be down at about 3.6% for today. But this again lags about 6 months. So over the coming months, we should start to really see inflation roll over because of this new housing data. So this is a pretty big deal. Now, the Fed does have another meeting coming up in July here, which you can see. They'll essentially announce the quarter point rate hike on the 26th. Now, I'm of the opinion that they're going to do this. Why? I think this is the last rate hike they do. All right. If we would have seen jobs number under 100,000 for on this past Friday, then I think they would have skipped the entire rate hike. But they didn't, although it was a weaker number than expected, which is weirdly a bullish sign, right? So what does all this mean? All right, well, let's come back to this chart. All right. So here again, we're going to see this June number roll over. All right. We are also going to start seeing the housing inflation come down and finally come through the numbers. Remember that lags by 6 months. In the meantime, Trueflation has been pretty accurate and it's been about 2 months behind. So right now it's saying that we're in the 2.5-ish number and we're in July. So 2 months out, call around September, we should be seeing that same thing. So let's see. Let's take a look at this. Again, here we can see that if we get, say, a zero point 0.1 for June, knock out this 1.2, we could be at 2.9, right? If we continue to see numbers like that, by the time we get to September, by the time we get to October, if we're seeing 0.2, 0.3, 0.1 type numbers, then these big numbers here are going to roll over. So that means that we'll probably be in the low 2 point something percent inflation come January and February. And if we see these numbers roll over as well, if we also see these come in smaller, well then it's my guess that they're going to start looking at interest rate cuts. All right. Now, this is all under the assumption that we have the Goldilocks scenario that they do not they do not put us into a recession, that these numbers just become smaller and smaller, 0.1, 0, 0.2, and that we don't go into the negatives, deflation, because that could happen. In fact, if we start seeing deflation, then all of this could happen a lot sooner, a lot faster. So this is something really to keep your eye out on. All right. I definitely think that the Fed is essentially done. This will be their last rate hike, is my opinion. And again, my opinion is going to change, right? I'm going to evolve as I get new data, right? I think it's important. Don't be that person that thinks it's pathetic or embarrassing or ignorant to flip-flop on your thoughts, right? Hey, you know what? If you don't want to flip-flop, if you don't want to learn when you get new inputs, then you're not going to learn. You're not going to be better. So always be willing to adapt and keep your mind as plastic as possible so that you can learn new things and make new analysis when new data presents itself. Now, the last thing I want to say is that I really do think that you need to take a bigger picture on everything. Okay. I understand that the Fed is jawboning and they're saying that they might do another two, maybe even three rate hikes. That's fine. Okay. In the big scheme of things, we're done with all the heavy lifting on interest rate hikes. Okay. This is why the market's been rallying. This is why we've been in the bull market, right? We are in a bull market as far as I'm concerned. Right. I think we're going to keep rallying. I think money's going to keep getting dumped into tech stocks. I think companies like Tesla are going to continue to do really well. Despite all the noise, the worst I think is behind us. And to be honest, if you look at China, China's in real trouble. People are leaving, companies are leaving China. Or companies are divesting away. China has a housing issue. They're trying to stimulate the economy. You see Europe's in big trouble. The UK's in really big trouble. Germany might be in a recession. The UK is going to be in a recession. You look all across the world, it's not great. The only real beacon of light out there right now is the United States. We're actually doing really well. The only thing we have to do is not screw it up. Not screw it up. If the Fed doesn't screw it up, then we should be fine. Now, the good thing, which is weird now, is that the Fed actually has some weapons. By raising rates, now every single time they raised rates, what they were doing is they're building up their stockpile of ammunition to fight against something that could come, right? So imagine we do start to slide into a recession. Well, guess what? They can start cutting rates, which is their ammunition, in order to stop the recession to stimulate the economy, right? Before, when they were essentially at zero, they used all of their tricks that they had. They had nothing else. If we were to continue to go into recession or deflation and we're at zero rates, that's it. There's nothing they can do. All they could do is pump money at that point, which is kind of what they did. But so I think there's a lot of room for optimism, cautious optimism. But I would guess that we get a good print on Wednesday. It would be amazing if we see a zero or a negative. That would be amazing. But I think we get a good print come Wednesday. I think the markets are going to like it. They're going to rally. They're going to believe that the Fed is in for one rate hike left, and I think we're kind of in a Goldilocks scenario here as long as they don't continue and screw things up. As far as core inflation, because you're going to hear them talk about core inflation during their next meeting, core is going to continue to come down. Remember, if you take out food and energy, that's core, right? That's core inflation. And it's coming down slower and slower. Well, the biggest part of that, if housing is about 40% of CPI and core inflation takes out food and energy, that means housing is an even bigger part of core inflation. And as we saw, housing comes down slowly, right? Because they're looking at these 6 month intervals, right? January, July, February, August, right? That's how they're looking at it. So it takes a time. Many Fed officials believe it takes about a year to see a deceleration, a deflation in housing and rents to come through the market. It takes about a year, 6 months to a year is what they estimate. So that's going to take time, and that's the biggest part of core CPI. So as we get into the year, as we get into the into the later parts of the third quarter and into the fourth quarter, we'll see all these net benefits of deflation. So lots of room to be optimistic here. Now, still, you never know what could happen, what black swan events could come about. You don't know if the Fed will raise rates too much and really send us into a panic. All that's possible. So take everything day by day, make your own decisions, none of this financial advice, do your own homework, come up with your own opinions, and just use this as a data point. All right, we're going to leave it there. If you enjoyed this, do me a favor. I don't have it here, but hit the like button, hit the subscribe button, and I'll talk to you guys.